Managing money effectively is crucial for a stable financial future. Unfortunately, many individuals struggle in this aspect, often resorting to excuses or misconceptions that hinder their progress. So let's explore some of the common reasons people give for not managing their finances and highlight the importance of overcoming these obstacles. By debunking these misconceptions, we hope to empower individuals to take charge of their financial well-being as well as make informed decisions. So today, I'll take you to 10 reasons people mismanage their money. If you're new to the channel, hit that subscribe button and that little notification bell icon so that you don't miss out on any of our video updates. Plus, it helps us spread the Thrive Wise love to help more people thrive wisely. Now, let's begin. Reason number 1, redefining wealth. A common misconception is associating the desire for wealth with greed or materialism. However, seeking financial prosperity is not inherently negative. Instead, it enables individuals to pursue personal passions, support their families, and live a fulfilling life. Defining wealth is subjective. It could mean having the financial freedom to explore interests, hire assistance, or create unforgettable experiences. By understanding the balance between financial abundance and personal values, individuals can align their financial goals with their aspirations. This holistic approach cultivates a rich life that encompasses personal fulfillment and generosity, empowering individuals to make a positive impact on their lives, as well as those around them. Reason number 2, overcoming investing fears. Investing is often perceived as intimidating and complex, leading many to shy away from it. Fear of financial scams or making poor investment choices can paralyze individuals. However, avoiding investing altogether can hinder long-term financial growth. Overcoming the misconception involves gaining a basic understanding of investment principles and seeking guidance from financial professionals. Building a diversified investment portfolio tailored to one's own risk tolerance and goals is key. By taking calculated risk and embracing the potential rewards, individuals can harness the power of investing to protect against inflation, generate their own wealth, and achieve their financial objectives. Reason number 3, lack of retirement planning. One pervasive financial fallacy is the belief that retirement planning is unnecessary. Some individuals claim they will never retire, while others overlook the possibility of declining health or changing circumstances. However, it is essential to recognize that everyone has a limited working lifespan. By neglecting retirement planning, individuals risk experiencing financial hardship and dependency in their later years. Overcoming this misconception involves acknowledging the value of saving, as well as investing early on in life. Even modest monthly contributions, when invested wisely, can grow substantially over time, ensuring financial security during retirement and providing the means to sustain the desired lifestyle. Reason number 4, ignoring debt collectors. The misconception that debt collectors will just go away if they're ignored stems from a desire to avoid confrontations and the stress associated with unpaid debts. Some individuals convince themselves that by not acknowledging the calls or letters from debt collectors, they can make the problem disappear. However, this approach only compounds the issue and can have severe consequences in the long run. The truth is that debt collectors are persistent and will continue their collection efforts until the debt is resolved. Ignoring them may lead to escalated collection actions, such as lawsuits or wage garnishments, which can significantly impact one's financial stability. To effectively address this misconception, individuals should adopt a more proactive approach. It starts with familiarizing oneself with consumer rights and protections. The Fair Debt Collection Practices Act, or FDCPA, outlines guidelines that debt collectors must adhere to when attempting to collect a debt. Understanding these rights can empower individuals to assert their position and take necessary steps to resolve the debt. Instead of avoiding debt collectors, individuals should engage with them to find potential solutions. Open communication can lead to negotiating a feasible payment plan, requesting debt validation to secure accuracy, or exploring the possibility of debt forgiveness. Debt collectors may be willing to work with individuals to reach a mutually beneficial agreement. Reason number 5. Underestimating the importance of credit scores. Some individuals believe that managing their credit score is only relevant when purchasing a home, dismissing its significance in other aspects of life. However, credit scores impact various financial opportunities and can either save or cost individuals a significant amount of money. It is crucial to recognize that credit scores are not limited to mortgage applications. Landlords often consider credit scores when evaluating rental applications, and utility companies conduct credit checks before granting household utility accounts. Banks and lenders review credit scores when approving personal loans, credit cards, and business loans. Therefore, managing debt responsibly and maintaining a healthy credit score is essential for financial well-being. By understanding the wide-range impact of credit scores, individuals can proactively manage their finances, secure better loan terms, and create a solid foundation for future financial endeavors. By the way, if you're enjoying this video, please take a moment to like and subscribe. It really helps us spread the Thrive Wise love, so we can help more people thrive wisely. And going back, reason number 6. Misguided borrowing from savings. Another common misconception is the belief that one can borrow from their savings and easily pay it back later. While it may seem like a sensible option for those in limited financial knowledge, the reality is quite different. Tapping into savings and failing to replenish them can lead to difficulties in catching up, and the interest or potential growth loss during that time can be significant. To address this misconception, individuals must recognize the challenge of recovering from a depleted savings account. If borrowing becomes necessary, it is crucial to adjust one's lifestyle and allocate funds to replenish the savings promptly. Prioritizing repayment and avoiding unnecessary expenses will help maintain financial stability and achieve long-term savings goals. Opting to borrow from oneself rather than relying on credit cards is a more favorable approach, as long as a clear plan is established to restore the borrowed amount as soon as possible. Reason number 7. Overestimating reliance on Social Security and Medicare. The misconception that Social Security and Medicare will sufficiently support individuals in retirement is a dangerous assumption that can leave individuals unprepared for their future financial needs. Many people believe that these government programs will be their primary sources of income and healthcare coverage, leading them to underestimate the importance of personal savings and retirement planning. In reality, Social Security was designed to be a safety net and not a comprehensive retirement income solution. The average Social Security benefit received by retirees is comparable to that of a minimum wage job, which is inadequate for a comfortable retirement lifestyle. Depending solely on Social Security benefits can result in a financial hardship, as well as limited resources during the later years of life. Reason number 8. Perceived insufficient funds for investment. Many individuals believe they do not have enough money to invest, assuming that it requires significant capital. However, this misconception can be debunked by examining personal spending habits. If one can afford daily visits to Starbucks, subscription services, luxury items, or indulgences like expensive dinners or vacations, then there is room for investment. By prioritizing long-term savings over non-essential material purchases, individuals often realize they have more disposable income for investment than they initially thought. Overspending on unnecessary items can quickly drain financial resources. Shifting the mindset to celebrate saving and resist impulsive purchases empowers individuals to accumulate funds for investment. Even small, consistent contributions can compound over time and contribute to wealth accumulation, creating opportunities for financial independence and future growth. Reason 9. Comparing spending habits with friends. The misconception of comparing one's spending habits with friends who earn less but seemingly enjoy a more extravagant lifestyle can be disheartening. It is important to realize that such friends may either have a grasp on conscious spending or lack effective money management skills. comparisons often neglect the underlying factors that contribute to financial decisions and outcomes. Emulating friends who make informed financial judgments and exercise prudence in their spending is more beneficial than idolizing those who engage in excessive spending beyond their means. By refocusing financial goals and seeking inspiration from individuals who prioritize financial well-being over material displays, one can align their actions with long-term financial success. It is crucial to avoid succumbing to societal pressure or the desire to keep up with other spending habits, as financial stability and wise money management brings more fulfillment in the long run. Reason number 10, not minimizing the impact of additional debt. The misconception that adding more charges to an existing debt burden won't make a difference stems from the difficulty of resisting consumer-driven spending temptations. Many individuals convince themselves that since they are already in debt, adding more charges won't significantly impact their situation. This mindset is akin to digging a deeper hole while being at the bottom of a very deep hole already, a paradoxical and counterproductive approach. It is crucial to recognize that one has the power to modify their financial circumstances. Getting out of debt takes time, but it is achievable. The journey to becoming debt-free may be long, but the feeling of financial security and freedom from living paycheck to paycheck is worth the effort. Concentrating efforts on paying one debt at a time, either focusing on the highest interest rate or the smallest balance, allows for steady progress towards debt elimination. Well, that's basically 10 reasons people mismanage their money. And thank you guys so much for watching today's video. And hey, it seems that YouTube thinks that the next video can completely transform your financial situation. Watch it to find out whether they're correct. And please don't forget to click the subscribe button to see more videos on how to thrive wisely. Till next time.